Worried about oil spikes? The bigger inflation risk could be plastics. A shock in the Strait of Hormuz would hit more than crude. It would raise the cost of petrochemicals and resins that sit inside almost every product you buy. Markets often watch barrels and tankers, but polymers like polyethylene and polypropylene start with oil and gas feedstocks that cross the same choke point. Those materials flow into packaging, autos, electronics, and healthcare. When resin prices rise, consumer prices and corporate margins feel it fast. Here is why this matters now. About a fifth of global crude and condensate moves through the strait. That flow anchors naphtha and ethane costs, which set the base for petrochemicals. Around 22% of global LNG also passes there, shaping power prices for chemical producers. When LNG is tight, the floor under polymer costs rises. A small set of resins drives most plastic demand. Polyethylene, polypropylene, and PVC cover well over half of the market, so price jumps cascade quickly into goods on shelves and materials on job sites. The backdrop has shifted since the pre-2020 playbook. Many companies run lean inventories after post-pandemic destocking. There is less cushion if feedstocks or resins spike. Shipping risks and insurance premia are higher, squeezing arbitrage and lifting delivered polymer costs. Pipelines can divert some crude, but there is no simple reroute for liquid chemicals or bagged resins. Central banks also watch every inflation print. Even modest, persistent goods inflation can delay expected rate cuts and compress equity multiples. Think about transmission. A protracted slowdown through the strait can tighten resin supply within weeks. Converters pay more for pellets. Packaging costs climb. Retailers face margin pressure or pass-through price increases. Autos, appliances, medical supplies, and building products encounter higher bill of materials costs. Earnings guidance shifts, especially for firms with weak pricing power or long global supply chains. Oil-heavy ETFs may not capture this second channel, so portfolios tied only to crude moves can miss the broader shock. What can you do? Track polymer benchmarks for PE, PP, and PVC, not just Brent. Watch LNG prices and freight and insurance rates in the Gulf. Listen for commentary from chemical majors, packaging firms, and consumer staples on input costs and inventory. Favor companies with pricing power, flexible sourcing, and clean balance sheets. Stress test rate expectations. If goods inflation lingers longer than the market implies. To go deeper into the data and signals to watch, read the full article at finlitica.com